Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, great to talk with you. Interesting times as always.
Mike, what's happening in the bond market right now?
Well, I think, as investors, we tend to look at what's going on in the Dow, the S&P 500, or gold, and so forth, and very little at what happens with bonds, even though most Americans will put anywhere from 40 to 60% of their money in bonds as a safe haven, because historically, since about 1980, bonds have gone up in value, and when the stock market's gone down, they've just gone up even more. So they have acted as a so-called safe haven. But this year, bonds have gone down in value. The TLT exchange traded fund, which tracks the 20-year Treasury bond, it fell 13% from New Year's to the low of last week. The LQD exchange traded fund, which tracks high-grade investment corporate bonds, it fell 7.3% this year. And when they were declining, the NASDAQ fell over 10%. So we have seen the stock market and the bond market fall at the same time at one point this year. And I think movements like that are going to happen periodically over the next several years. And the reason why is that bonds are tied to interest rates and yields, and when yields go up, bonds go down. And we saw a secular low in interest rates and yields last year. In fact, the lowest yield ever for junk bonds happened April last year. When the stock market crashed last March, the Federal Reserve announced all these bond buying operations, and all the yields collapsed to record lows, and we are going up from that level. But yields also are tied into inflation, and inflation is going to grow. Last week, there was a Federal Reserve meeting, and Jerome Powell, the chairman, gave a press conference after the meeting in which he predicted that CPI inflation would go up to 2.5% this year, starting in just the next couple months, as the virus situation in the United States gets better and things open up more, people travel more, people spend more money. We got the stimulus bills that are already injecting about $1,400 in many people's pockets, and even more if they got children. And then there's now talk of a $3 trillion infrastructure stimulus package that the Biden administration is preparing. So lots and lots of money is coming to the economy, and the Fed is predicting inflation is going to grow. And these are trends that are helping the stock market for now, are going to help the economy grow, but they're going to create inflation, which is going to hurt the bond market. And this is going to hurt Americans who have so much of their money tied up in bonds. And I think this is the biggest challenge that they face. Not bubble stocks that could blow up, or bubble ETFs like the ARK ETF, which I think is problematic, but the bond market, which is even more problematic in the long run. And I think if we step back, one of the key issues is, and I don't know the answer to it exactly, but when Powell predicted that inflation is going to get to 2.5% this year, he also predicted that it'll go back down next year below 2%. And that's a prediction that, and they will, the implication would be that he won't have to raise rates next year, that things will be okay with inflation, it won't be a big problem. But if that prediction turns out not to be correct and inflation doesn't go down, then it will create a lot of volatility in the financial markets in the second half of next year and hurt bond funds even more. And so I think that's something we all have to be on guard of. We can't just trust in a prediction made by the Federal Reserve Chairman, because I have no idea what he's basing it on, and he doesn't tell us. And in 2006, Ben Bernanke made a prediction that real estate prices are not going to fall; they'll bottom out, and because they peaked out and had dropped. And he said it won't be a problem. Don't worry about it. And of course, 2008 came, and we saw it was the biggest economic problem in decades. So this inflation and what happens in the bond market in the second half of this year could also become a huge defining factor in the next couple of years. So we got to be on top of all this and keep our eye out on it, even though right now bonds are oversold. They're putting on a bounce. The stock market, is trading a little bit less volatile. It probably will continue to do that. I don't really expect anything big to happen over the next couple of weeks. People are kind of falling asleep in a sense, taking vacations, and, not much is seemingly happening day to day. Even in the news cycle has kind of calmed down, but things may materialize later this year.
Some people have suggested when the market is calm like this, it looks like calm water, but you don't realize it that a subsurface volcano has erupted. There's a lot of volatility underneath the surface, and when it does hit the surface, this could cause another major correction, just like we saw this time last year.
Yeah, well, historically, when there's a lot of you kind of go through periods of extreme volatility, and then a period where volatility shrinks, then it gets extreme again. So last year actually marked the most extreme volatility in the financial markets ever, even more than 2008, because all volatility means is how quickly a market moves, and we saw the fastest drop off of a high last March when the S&P 500 fell over 32%. It actually fell faster off a high than it did in 1987 and 1929. It fell more than those 2 years, but the initial drop off the high was faster last year. But what was just as remarkable, and people think volatility simply means price declines. Not necessarily. Volatility just means the speed of price movements. And after that big decline, we saw the market go up at the fastest rate ever, too, to new highs and beyond. From the low, it went up over 75% by Labor Day of last year. So those months from March to September marked a period of time in the markets which were the largest period of volatility ever in the Dow and the S&P 500. Well, when you see that, typically what will happen is you'll get a period of lower volatility in the markets, and it appears that may be what is finally starting to happen. The the Nasdaq fell over 10% the other week, and it's got oversold. It's coming back. It's taken back about half those losses. The Dow made a new high last week, but after it made that new high, it hasn't gone anywhere. And that's what kind of characterizes low volatility, is when a market can make a new high, but nothing really happens. Or it falls 10% and nothing really happens. So you can get a market that's trading in like a 5 or 10% range, and that creates lower volatility. And it seems to me that's what we're kind of entering, and it would likely last a couple months and then lead to a period of heightened volatility in the second half of this year. There's no way to really predict which direction it would be in. If there's trouble in the bond markets, it would likely be down. If there isn't, then maybe it would be up. but whether or not there is probably is going to be determined by whether inflation goes away or actually picks up. What if inflation gets beyond the predictions of Powell? That would cause turmoil much, later in the year. So I think we're in a calming period, as you aptly put it, where there's potential problems later. Another thing, though, to look out for is the stocks that fell the most the other week. These big cap technology stocks and fad stocks such as Tesla, many of the stocks that had gone up and led the market from 2009 up until September, these popular big cap technology stocks, the Nvidias, the Netflixes, they actually led and declined the most in February when the Nasdaq pulled back, and they kind of put on weak bounces. So if there is more weakness in the market, they will probably be a source of that. So that's something I think people need to keep their eye on. At the same time, what has been there's two ways to look at it. One is these are troubling signs, and it's going to break down again and drag the whole market down with it. There's an alternative way to look at it, and that is that what we're actually seeing is a great rotation out of past winners into sectors in the stock market that are going to benefit the most from the economy getting better. So we're seeing rises in bank stocks recently. This is why the Dow's outperformed the NASDAQ. We've seen real estate investment trusts go up. Energy stocks are doing very well. Casino stocks, some of them made a new high the other week. Airliners and so forth. So that's one way of looking at this. But again, you could have saw the same thing in the summer of 2000 where the NASDAQ broke down and money flowed into so-called what they're calling real economy stocks or old economy stocks back then. So all this is to say that however you want to be bullish or bearish on what may happen in the second half, we're seeing consolidation, lowered volatility, and sort of a churning of money out of the former big winners into other sectors. And that can happen in the top or just a market that's, churning and getting ready to move up again later. Either way, the pattern of the moment is the same, churning sideways. It is probably going to last a couple months. And in a lot of ways, it may not seem like much is really happening. And it's tough for most people to make a lot of money trading a sideways market. And what I'm focusing on myself are some sectors that aren't making new 52-week highs or breaking down or something, but looking for sectors that had pulled back, appear to be oversold, or didn't go up as much as the rest of the market. So I just mentioned two. Shipping stocks is one. This is a sector that bottomed out like in December, continued to decline even with the market going up, and appear to have turned up last month. Another sector is frankly the gold and silver mining stocks, because gold pulled back to support really from July to 2 or 3 weeks ago, and is just kind of floating around the 1700 level, which looks to me like a long-term support level now. It's the point of basically the 200-day lower Bollinger Band. I'm not sure if gold's just going to take off and go straight up, but it looks to me like it's at the bottom of a long, drawn-out consolidation that started months ago. It may continue for more months, but this looks like we're at the lower support portion of it, so it's a good buying position, and also for mining stocks too. So I think those are the two areas where there's the best spots to try to make money if you're looking to do some buying.
We'll have more with Mike Swanson right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Mike Swanson. Mike, what's going on with precious metals, and not just gold and silver, but palladium and platinum?
Well, palladium and platinum soared last year from April really past November, but they're also pulling back at the moment. Really, almost the entire commodity complex started to pull back about 3 weeks ago. Energy stocks, or energy itself, oil, has fallen almost 10% from its recent high after having gone up tremendously from around the time of the election. Stocks like Exxon more than doubled from November to their recent peak in February. And the same thing has happened with copper mining stocks, which even did better than energy stocks, but stocks like Rio Tinto, BHP Bulletin, which is more of a materials company, Southern Copper, they all kind of trade together. These companies all had huge runs really starting from April up until around New Year's, and have pulled back in recent, the past couple of weeks. It's kind of to be expected. So you're going to get a pullback every once in a while. But I'm bullish on all these things because I think we are going to get inflation. I think the Fed's underestimating how it's going to play out over the next couple of years. And these are sectors that I believe will do well, not just in the next couple of months, but over the next couple of years or the rest of this decade for that matter. So I think they're buyers on pullbacks, and I think they're going through a consolidation phase at the moment. Probably seen, hopefully, in them the extent of the recent decline, and now they're going to start to chop sideways.
We'll have more with Mike Swanson right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, there's talk of a $3 trillion infrastructure program in the U.S. What's that going to do for stocks that involve steel, concrete, scandium, which is used to harden the steel rebar, resources like that, construction companies?
Well, I mean, they're all being bid up as we speak, really, going into it. And I think it's just going to help them even more. Yeah, I think we're going to... Well, I was talking to someone just before talking with you that told me they were speaking with someone that works in the school system, and that that they're expecting to get $9 million, and they got to spend it from the federal government. They're going to have to spend it on infrastructure in 12 months, forced to spend the money. So multiply that throughout the entire country, and that's the sort of thing a $3 trillion infrastructure bill is going to do. And it's going to be inflationary, because if you're forcing people to spend money in a certain amount of time, they got to find workers to do the job. You might have to pay more than you would, and there's going to be competition in getting people to work. That's why you may have to pay more. So I think this is all going to be inflationary, which also is good for metals and steel companies and everything else. So I think that's, maybe one way to look at everything we're talking about is over the past several years, the big play has been big cap technology stocks, Apple, Amazon, Facebook, and things I think are fads like Tesla. Well, now really the big play is going to be commodity related, infrastructure related, and so forth, because they're tied into these type of stimulus programs, as you mentioned, and they also are sectors that benefit when there is inflation.
You were saying also sectors like casinos, holiday resorts, even cruise ships. Once people feel safe to get out there again, perhaps money that they would have put into the stock market because they had nothing else to do with it. Well, now if they're making holiday plans, that money won't be going into the stock market. Will it affect the overall stock market?
Well, it could in the second half of the year. I mean, the evidence suggests right now, these people are getting $1,400 stimulus checks, and saw a statistic that said that people under 30, they're going to put 60% of them say they're putting the money in the stock market, on their Robinhood accounts and whatnot. But are they going to be doing that in a couple months? And what about, as you mentioned, other people that, are ready to travel? I also saw surveys that said older people are itching to, the first thing they want to do is travel as soon as they get their vaccine, on cruise ships, to casinos or wherever it may be. That's going to help the hotel industry for sure. But I think a lot of these stocks have bid up into this sort of thing so much, that they may have seen already 90% of their move. So it's tough to know. I think if you want to play it, you got to buy now and, not wait until the earnings news is showing all the good news. I think that might be the time to sell, which would probably be in the second or third quarter. Probably the third quarter would reflect the benefits of all this. Basically, buy the rumor now and sell the news later.
Well, with all this planned spending, we know, people just want to get out there and socialize, see family, and have a little me time that isn't enforced by some government rule that, a staycation, we have found out, isn't that much fun.
Yeah, for sure. And this is also a reason I think these technology things that benefited so much are things that dump. Netflix, for example, I got it and I'm sick of it. I don't want to watch this thing anymore. I want to get out of my house. The weather's going to be nicer. So I think it might be time for me to cancel Netflix. And probably there's many millions of people thinking the same thing. But, Netflix is one of the better technology things. There's things that have benefited so outrageously from, the stay-at-home thing that I don't know what future they have anymore. I mentioned another thing, Peloton, for example. This is a company that has boomed because they make stationary bicycles that have a monitor on them, and you can press a button and see a video showing, making it look like you're biking down the road or in a mountain or something. Well, if you like to bike, you may sit on your Peloton when you're afraid of the virus, but once you're no longer afraid of the virus, you really want to do that with your life anymore. I don't think people do, and you don't want to spend money paying a monthly fee to watch these silly videos on a bike. So I think that's a company that, got bid up way too much. Its stock did, and is kind of silly. It's a fad, and get out, is my recommendation. Get out of Peloton and, buy something that's more likely to benefit in the long run from a more normalized economy. Zoom is another thing that people have been forced to use it, and the stock has been one of the biggest gainers of last year, but people are sick of Zoom. Zoom meetings are not much fun. They don't replace being in front of someone in real life, and that stock was one of the biggest decliners in February. So I think that's to look out for. Stocks that went up the most last year and then declined the most in February. Those are the stocks to get out over the next couple weeks because they're bouncing at the moment. Jump out of them they're fads, and people are sick of being zoomies. They want to go out into the real world now, and people are going to do it one after another as they shake off their fears of the virus. They get the vaccine, or they just decide, I'm not going to live like this anymore. But one by one, that's what people are going to do.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.